On Friday, October 13th, 1307, King Philip IV of France did something no one had managed before. He arrested every Knight Templar in his kingdom on the very same day. Sealed orders had gone out weeks earlier to royal officials across France, with strict instructions not to open them until that single, coordinated morning. The official charge was heresy. The real motive, most historians agree, was considerably simpler. Philip owed the Templars an enormous amount of money, and a debtor with an army has a very direct way of solving that problem. Some later writers have tied this date to the superstition around Friday the 13th, though historians are divided on whether that connection is genuinely medieval or a much more modern invention. Either way, the story of how a militant religious order became Europe's most trusted bank, and why that trust ultimately destroyed it, starts more than a century earlier. Before there were banks in any recognizable sense, moving money across any real distance was a genuinely dangerous business. A nobleman traveling to fight in the Crusades, or a merchant crossing multiple territories, had exactly one practical way to carry his wealth. Physically, in coin, strapped to himself or loaded onto a cart. Every mile of that journey was a mile of exposure to bandits, corrupt local officials, and simple bad luck. Losing your money on the road didn't just mean losing your money. It could mean arriving penniless in a foreign land with no way to fight, trade, or even eat. Entire noble households were known to hire small private armies of guards for the sole purpose of protecting a single shipment of coin across a few hundred miles of contested territory, an expense that often ate up a meaningful share of whatever wealth was being transported in the first place. What medieval Europe needed was some kind of institution trustworthy enough and geographically widespread enough to let a person deposit funds in one place and draw on them somewhere else entirely, without ever moving the physical coin at all. It's the same underlying puzzle we've circled twice already on this channel. Coins that were too heavy to move easily, paper that had to be trusted rather than weighed. Only this time, the missing piece wasn't a new object at all. It was an institution. Remarkably, the organization that ended up solving this problem wasn't a merchant house or a royal treasury. It was an army of monks. The Knights Templar were founded around 1119, originally to protect Christian pilgrims making the dangerous journey to Jerusalem after the First Crusade. Within a couple of decades, papal recognition gave the order sweeping privileges: exemption from local taxes, exemption from local church authority, and the right to operate its own network of properties across both Europe and the Crusader states in the Holy Land. By the height of the order's power, the Templars controlled a network of several hundred castles, commanderies, and fortified houses stretching from Portugal to the Kingdom of Jerusalem, a physical infrastructure no single kingdom of the era could match. That network is the part that mattered most. A pilgrim or nobleman could walk into a Templar house in London or Paris, hand over a sum of money, and receive a sealed letter documenting the deposit. Carrying that single piece of paper across an entire continent was far safer than carrying the equivalent in coin. Upon arrival at a Templar house near Jerusalem, that same letter could be presented and the funds withdrawn in local currency from an entirely different building on an entirely different landmass. It's the same basic trick as the Tang dynasty's flying cash we covered in episode 2, arrived at independently, half a world away, by men who had almost certainly never heard of it. Word of a network this reliable didn't stay confined to pilgrims for long. Kings, nobles, and even rival religious institutions began depositing their own wealth with the Templars simply because the order's reputation for security and honesty was, by the standards of the time, nearly unimpeachable. The Paris Temple, the order's fortified headquarters in the French capital, gradually became something close to a royal treasury in all but name, at times literally holding the French crown's own jewels and reserve coinage under Templar guard, administered by Templar officials rather than royal ones. Kings of England made similar use of Templar houses in London for safekeeping crown funds during military campaigns abroad. The order began extending credit too, lending to monarchs who needed funds for military campaigns, castle building, or simply keeping their kingdoms solvent between tax collections. As a religious order, the Templars were technically bound by the same prohibition on usury that would later constrain the Florentines. So loans typically carried no stated interest at all, only administrative fees and penalties for late repayment substantial enough to function as interest in every way except name. None of this required the Templars to abandon their original identity. They were still, on paper and in practice, a militant religious order sworn to poverty as individuals. But the order itself, as an institution, had become extraordinarily wealthy and extraordinarily useful to the very monarchs who might one day resent owing it money. Philip IV was exactly that kind of monarch, and by the early 1300s his debts to the Templars had grown substantial. He wasn't a man inclined to let a debt sit unresolved. A few years earlier, he had already expelled France's Jewish population and seized their assets, and leaned hard on Lombard bankers, using remarkably similar justifications each time. The Templars, with their own fortified compounds and military training, were a harder target than either group, which may explain why Philip needed the full weight of a coordinated royal arrest, and the Church's own machinery of heresy trials to bring them down. The charges themselves ranged from denying Christ to worshipping idols to various forms of ritual impropriety, accusations that historians today largely treat as fabrications shaped to fit whatever confession torture could produce, rather than any genuine underlying practice. Confessions, many extracted under torture, produced the accusations needed to justify seizing Templar assets across France, and Pope Clement V, under enormous pressure from Philip, formally dissolved the order entirely in 1312 through the papal bull Vox in Excelso. The order's Grand Master, Jacques de Molay, confessed under duress, later recanted publicly, and was burned at the stake in Paris in March of 1314. According to a persistent legend, Molay cursed both Philip and Pope Clement V from the flames, predicting they would not outlive the year. Whether or not the curse was real, both men were dead within 12 months. The Templars' vast property holdings were formally transferred to a rival order by papal decree, though a considerable share of the wealth and the debts Philip owed simply evaporated, along with the order that held the paperwork. It's worth noting that Philip's money troubles were never really solved by the arrests alone. He'd already spent years quietly reducing the precious metal content of French coinage, while insisting on its old face value. The same trick Episode 1 examined in reverse. Debtors and monetary tricksters, it turns out, tend to be the same kind of ruler. The problem the Templars had solved, moving and storing money safely across distance, didn't disappear with them. It resurfaced roughly a century later in Florence, a city whose wool trade and textile industry had made it one of the wealthiest commercial centres in Europe. But Florence's merchants faced a constraint the Templars never had to worry about quite so directly: the Catholic Church's strict prohibition on usury, the charging of interest on loans, which canon law treated as a serious sin regardless of who was doing the lending. A booming trade economy without any legal mechanism for extending credit is a contradiction that eventually forces its own solution, and Florentine merchant bankers found one clever enough to satisfy both their ledgers and their confessors. The Medici were not even the first Florentine family to attempt large-scale international banking. Decades earlier, the Bardi and Peruzzi families had built banking houses of their own, only to collapse spectacularly in the 1340s after extending enormous loans to King Edward III of England to help finance his wars in France, loans the English crown never fully repaid. It was a cautionary tale the Medici would have known intimately, and in time would fail to fully heed themselves. The workaround was an instrument called the Bill of Exchange. Rather than lending money and charging interest outright, a banker would effectively sell currency in one city for delivery of a different currency in another city at a future date at an exchange rate that happened to favor the banker. Technically, no interest had been charged at all, only a currency conversion. Practically, the banker's profit functioned exactly like interest would have, just wrapped in the language of foreign exchange rather than lending. In practice, a merchant in Florence needing funds might sell a bill promising repayment in Bruges gold weeks or months later, in an amount that quietly built in the banker's margin through the exchange rate itself, rather than through any interest rate a confessor could object to. It was a distinction fine enough to satisfy church law, while still letting merchant capital circulate and grow. This single instrument, more than any other innovation of the period, is what allowed Italian merchant banking to expand safely across borders, and it's the foundation on which one family would build something considerably larger than a single Florentine trading house. In 1397, a Florentine banker named Giovanni di Bicci de' Medici founded what would become the Medici Bank, built on exactly this Bill of Exchange model, and structured in a way that was, for its time, remarkably sophisticated. Rather than operating as a single, unified company, the bank functioned as a network of semi-independent branches, each structured as its own partnership, with local managers who held a direct financial stake in that branch's performance. If a branch in Venice or Rome made poor lending decisions, the losses were largely contained to that branch, rather than threatening the entire institution outright. The bank's internal record-keeping relied on increasingly refined double-entry bookkeeping, a system that let managers in Florence track the true financial health of distant branches with a clarity most European institutions of the era simply didn't have access to. At its height, the bank operated branches in Rome, Venice, Milan, Naples, Geneva, Bruges, London and Avignon, each staffed by local managers who understood their own market intimately, while Florence retained oversight of the network as a whole. It was, in effect, a holding company, centuries before anyone used that term. The single relationship that turned the Medici from a wealthy Florentine trading house into one of the most powerful financial institutions in Europe was the bank's role managing the finances of the papacy itself. The Medici collected church revenue from across Catholic Europe, moved those funds to Rome through their own branch network, and handled the Vatican's day-to-day banking needs. Being the Pope's banker meant privileged access to enormous, steady cash flows, and, just as importantly, an unmatched web of political relationships stretching into every court in Christian Europe. The relationship went beyond simple bookkeeping, too. The Medici also secured a lucrative monopoly on trading alum, a mineral essential to the European textile industry, mined from newly discovered deposits at Tolfa within the Papal States, adding yet another steady revenue stream tied directly to Rome. The relationship ran deep enough, in fact, that two future members of the Medici family would eventually be elected Pope themselves, Leo X and Clement VII. A level of access no ordinary banking relationship could have purchased on its own. Wealth built a bank. This particular client turned that bank into something closer to a permanent fixture of European power itself. That power reached its clearest expression in the career of Cosimo de' Medici, Giovanni's son. Rival families, alarmed at how much influence Medici money already commanded, had Cosimo briefly exiled from Florence in 1433 on manufactured political charges. It backfired badly. Cosimo returned in triumph the following year and proceeded to do something almost without precedent. He came to dominate the city's politics entirely, without ever holding a formal title that would have made him Florence's ruler. He didn't need one. Through strategic loans, calculated patronage, and a network of political allies who owed their positions directly or indirectly to Medici money, Cosimo controlled the machinery of a nominally republican city from behind the scenes. He also poured Medici wealth into public patronage, funding architecture, scholarship, and art across the city, cementing loyalty through visible generosity as much as through private ledgers. It's a template later generations would recognize immediately. Influence purchased not through conquest or coronation, but through the simple, persistent leverage of controlling who could and couldn't get credit. No banking empire built on cross-border lending stays invulnerable forever, and the Medici Bank's most damaging wounds came from exactly the kind of clients who were hardest to refuse: kings. The bank's London branch extended substantial loans to the English crown during the turbulent decades of the Wars of the Roses, a conflict that made royal finances and royal promises to repay spectacularly unreliable. When King Edward IV failed to make good on his debts, the London branch absorbed losses substantial enough that the branch itself eventually had to be closed outright, a direct echo of the exact mistake that had destroyed the Bardi and Peruzzi over a century earlier, and one the Medici had somehow made anyway. The Bruges branch, similarly exposed to the shifting fortunes of Burgundian nobility, faced comparable strain. A bank that had built its reputation on careful, distributed risk was discovering that some borrowers were simply too powerful to collect from, no matter how sound the original bookkeeping had been. By the time Lorenzo de' Medici, known to history as Lorenzo the Magnificent, inherited control of the family's affairs, his attention had drifted heavily toward politics, culture, and the patronage of art and scholarship that would make the Medici name legendary for entirely different reasons. Bank management suffered for it. Bad loans went uncorrected, branch oversight weakened, and by 1494, when a French invasion under Charles VIII triggered Florence's political collapse and the temporary expulsion of the Medici family itself, the bank that had financed popes and kings quietly ceased to exist. But the tools it had refined outlived the institution completely. Double-entry bookkeeping, the branch-based partnership model, and the bill of exchange as a workaround for lending restrictions all became permanent fixtures of European finance, copied and refined by the banking houses that followed. The Templars had proven that trust could move money across a continent. The Medici had proven that trust, structured correctly, could be turned into lasting institutional power, and that the same structure could just as easily turn into a liability the moment a king simply decided not to pay. Every major bank that followed, from the merchant houses of Amsterdam to the institutions issuing the currency in your own pocket, still runs on some version of the ledger the Medici perfected and the risk the Templars never lived to fully understand. Every instrument has a story. This was the third one.